Good evening. Welcome to the third quarter results update of HNB. We will first start with the presentation and then we'll open the floor for questions. So can I invite Priyanka Vijayaratna, who's our AGM strategy, to take us through the presentation, and thereafter I'll join for the Q&A. Over to you, Priyanka.
Thanks, Rajiv. Good evening to all of you. Let me very briefly take you through the performance of HNB over the past 9 months. So as you know very well, since March, after the central bank increased the policy rates, the PLR has increased very significantly. And as you can see from the graph on the left, from September last year to September 2022, PLR has increased by about 19 percentage points and on average by about 12 percentage points. So this has been the key reason for the 82% increase in our interest income. So the same interest rate impact is seen on our interest expenses as well. And on top of that, deposits grew by 25% during the year. This was partly through the 80% devaluation of the currency. But even if you look at our LKR deposit book, it has grown by about 17%. Equivalent to about 146 billion rupees in deposits. So in effect, our NII has grown by almost 90% to 77 billion as at end of 9 months. And also, as you can see in the graph to the right, margins have improved significantly by about 300 basis points. Moving on to the fee income. You can see that the fee commission income has grown by about 62% year on year. This is largely on account of trade fees, card volumes, increase in digital fees, etc. And if you look at the exchange gains, it has improved mainly because of the rupee devaluation. And of course, the insurance premium has also grown by about 25%. And in effect, our total income has grown by 91% during the 9 months compared to last year. But this 91% increase in our total income has been basically taken over by the increased impairment. As you can see, our impairment for the 9 months has increased to 61 billion. Out of this 61 billion, almost 2/3 is on account of impairments on foreign currency denominated government securities. So it has gone up to 41 billion for the 9 months, and the loan impairment on loans and advances is at 20 billion for the period, which is again a 90% increase. If you look at non-performing equivalent indicators for the period, our stage 3 ratio increased from about 2.5% as at end of last year to about 3.34%. But this is one of the best in the industry. And our stage 3 cover of 56 is at 56%. And that's also one of the best in the industry. Moving on, overall expenses increased by about 26% in the background of a 70% year-on-year inflation. Although the expenses increased by 26%, the higher growth in income resulted in a cost-to-income ratio improving significantly to around 23%. As at end of September, and at a group level, this was around 31.6%. So in terms of tax, as you know, VAT is at 18%. And in effect, the group made 11.6 billion for the 9 months, and it was compared to last year due to the high increase in impairments. It was a year-on-year drop of 13%. Moving on to our key indicators in terms of soundness stability, our capital adequacy tier 1 ratio remains about 180 basis points above the minimum requirement of 9.5%. Total capital is at a 14.36%. And on top of this, as you know, the central bank has allowed banks to draw down up to a further 250 basis points on capital adequacy. Liquidity ratios also remain well above the statutory levels. So LAR is at 30% against the requirement of 20%, and the LCR is almost at 220%. And finally, looking at the DuPont, as I mentioned earlier, you can see that our NII and other income has improved significantly, and that increase is close to about 4%, but that entire amount has been taken off by the impairment, which has grown from 1.12 to 5%. And we've seen a slight increase in operating costs as well. So as a result, ROE has dropped from 10.8 to 8.4. So that's it on the numbers. So we open up for any questions that you may have.
Thanks, Priyanka, for that. And I have here Priyanka and Anuradhi, who's head of finance, also joining me for the Q&A session.
Hi, Rajiv. It's Naveen here from Linear. Can I ask a couple of questions?
Go ahead, Naveen.
Just a couple of questions on your ISB holdings. What's the current outstanding face value of the ISBs that you have on your books?
So the exact amount is not in the public domain, but so on the ISBs, so it'll be plus of $500 million.
Okay, thank you. And as at September, how much of an impairment have you taken on those and also on the SLDBs?
So we have come, so SLDBs, most of SLDBs have got paid in rupees. So we haven't significantly increased the impairment on SLDBs from where it was last year. On the ISBs, we have come close to 30% on impairments.
That's a 30% on the carrying value, is it, or 30% on face?
30% on the value in the balance sheet, carrying value.
Right, thank you.
But there's not much of a difference because most of these bonds we had purchased about 3-4 years back, maybe even before COVID. So it's very close to the par value.
If I remember right, you all also bought quite a bit in 2020, which I presume would have been at some sort of discounts.
Not very big discounts.
And one last question, I'll hand it over to the others. What kind of risk weighting do you all use for the ISBs and SLDBs? Are they still zero risk weighted, or is there a non-zero risk weighting on these?
So there is a 20% risk weighting on the ISPs. That has been there for some time. I think central bank reduced it to 10% during COVID time to give some capital relief, but it's gone up to 20% again.
Okay, thank you, Rajiv. That's it for me from the moment.
Hi, Rajiv. It's Ramali, also from Linear.
Yes, Ramali.
Just had a question on the liquidity and also the new changes to the liquidity ratio. How are SLDBs and ISB is currently treated in the liquidity ratio, and with the changes, do you expect to see a increase in your overall liquidity computation?
So SLDBs are taken on face value, ISBs are taken on the market value. So that's how it's been taken for calculation. In terms of the ratio, there might be a slight increase in the ratio, but I think it's more than an increase in the ratio. I guess this was needed because we don't have any, I would say, liquid asset instruments available in the market to invest. Nobody really would want to invest in ISBs and SLDBs to maintain a foreign currency liquid asset ratio. So I think to that extent, it helps the banks because you can invest probably in treasury bill bonds or in the interbank and qualify for the LAR requirement rather than being forced to invest in foreign currency denominated asset for LAR purposes.
Okay. Would that impact the open positions also, or there's no change to that?
No, it won't impact because it's just that you're not going to take a foreign currency deposit, convert that and put in LKR investment. No, what you'll do is you'll manage your balance sheet. You'll probably have less amount of LKR loans and a higher amount of LKR liquidity and maybe a slightly lesser amount of US dollar. But then I guess uh, so it won't hit the NOP, but of course, at present, what we have seen is compared to where we were maybe 5-6 months back, the dollar liquidity position has improved. So I don't know, some of maybe at least the larger banks see a lot of funds in our Nostro accounts on US dollar because even on the lending side, you hardly find any opportunities to lend in US dollars, neither is there any opportunities to invest.
Okay.
So the liquidity in dollars have improved significantly.
Okay. Thanks.
Rajiv, this is Naveen here again. How is the rupee liquidity situation at the moment?
So rupee liquidity situation is also fairly good in terms of our LARs are around 30%. So which tells you that there is a lot of money going into liquid assets because deposit growth has been fairly high, like Priyanka presented, compared to loan growth being in low or mid single digit numbers. So as a result, there's good increase in liquid assets and the liquid asset ratio.
Okay, thank you.
There is a question on whether there is an impairment on ISBs included in other income. The exchange impact of not only on ISBs but all foreign currency denominated loans, the impairment figure, the impairment impact coming through the exchange depreciation is included in the other income line. So that is there, but the remaining impairment in terms of because of the increase in risk profile is included under collective impairments. I hope I was clear in that answer. So on HNB Finance, the loss was mainly because the um, FD cost has gone up significantly. Their funding cost has increased while most of their loans are fixed in nature. Micro leases are fixed, as well as on the micro lending side. There was a interest cap that the government had imposed, which subsequently was removed with interest rates going up. So they have repriced their book now, most of the loans, and they've brought. So we are expecting the company to start turning around, making profits, and the expectation is that they will end up with at least at a break even or at a small profit at the year end, which is their year end is March 31st. So that's the expectation. So there's a question in terms of how do you calculate stage 3 ratio? Stage 3 ratio is calculated taking all stage 3 loans minus impairment for those stage 3 loans divided by gross loans. So there is a question in terms of breakdown of variable and fixed rate loans. I would say around close to 80%, 75 to 80% of our loan book either get repriced within 1 year, matures within 1 year, or gets repriced within 1 year. So majority in that sense are variable. And that's that's the reason why you'll also see that our NII growth is significantly high compared to the industry. And also the other fact is that treasury investments have been short term. So therefore that has also helped reprice the investment portfolio. So LAR calculation, what is included in the denominator is all the liabilities of the bank. So you take the liability side of the balance sheet, and from that you take the shareholders' funds or the equity component out. The rest of it is included in the denominator. So medium-term view on impairments, on loan impairments, at least third quarter, we have seen an improvement compared to the second quarter where things were really bad, and we saw a significant movement in buckets. So since then things have improved, but we still probably as a country are not out of the woods. So we'll need to wait and see how taxation and continuing of these high interest rates have an impact on the repayment capacity. It's difficult to really predict, but hopefully we think that we have seen the worst. But for that, of course, we also hope that these IMF agreements will be signed and you'll see cash flows flowing into the country, and we will not have another disruption like we have seen. So we believe that we have probably seen the worst. but any of these variables change into the worst could change things. So it's difficult to predict, but we feel that we have seen the worst. On the ISP side, again, negotiations are ongoing with with the government. We have also onboarded a financial advisor to the 8 banks that have got together in order to negotiate with the government on the ISB holding. So we'll continue to take forward these negotiations, and based on that, we will have better indications in terms of how much we will have to take. But we are quite hopeful that the government will see banks as a special creditor group, because in order to achieve that sustainability ratios for the government, it's important that the banking sector support the economy, and that will help to improve the GDP numbers, and that in turn will help to achieve some of these debt sustainability ratios. So in that sense, we believe that we will be offered some kind of solutions that will be favorable to the banking sector, because without that, it'll be difficult for the whole economy to move forward. So that's our take on the ISPs, and that's how the negotiations are going forward. So HNB Finance NPL ratio, offhand I can't remember, but I believe it's somewhere in the range of 14 to 15%. So collective agreements were signed last year. So the next round of collective agreements will be in 2024. But of course, there might be certain adjustments that will need to be done in terms of, usually that's been done for the executive staff on an annual basis, and only on the non-executive staff that there is a 3-year collective agreement. But also in order to support some of the staff who are earning low income salaries, we have supplemented them by giving a monthly allowance. So that it has already been done. So T-bill bond mix has not changed by much. It remains more or less the same, because we have remained we have been investing more in treasury bills and hardly any on treasury bonds. So the mix wouldn't have changed much. So core capital on HNB Finance came down as a result of the merger or an acquisition of Prime Finance that they did under the consolidation plan of central bank. As a result of that, central bank has also given certain leeways for a period of 3 to 4 years for HNB Finance on capital ratios because of this amalgamation. However, they will look at they will have their own capital augmentation plans, and but I believe at 7.03%, they are above their minimum requirement given by a central bank. So corporate is around 45%. retail would be around 20% and SME would be about 28% on the loan book. On HNB finance, impairment would be basically taking into consideration the stress situation based on the bucket movements. But though you say it's 157% in terms of rupee value, it's not too large. But they are, as I mentioned earlier, they are looking at making profits for the full year, and they are working towards that. It's difficult to say, but definitely we believe that it will be in single digits loan growth. When I say single digit, I meant for the full year loan growth for the bank would be in single digits. So the quarter, so you would assume that there won't be a significant growth for the quarter either. Any more questions? If there are no other questions, let me thank everyone for joining this call, and we hope to meet you all again with our fourth quarter numbers. Thank you very much and have a great day.